So this comes from our webinar where we talked about looking at 10x stocks. And really, we're talking about these type of stocks, 10 to 200x stocks from our research, such as Hammond Power, Boyd, Water Furnace, Boyd, Expel, Janus Systems. What are some of the core criteria in the profile that we're looking at to identify these stocks? So we gave 10 there. There are more than 10 that we look for when we're looking for individual companies. But I'm going to present today 5 of the 10 criteria we presented at that live webinar. Now, the first that I'm going to look at in the profile of a 10x stock, most companies, again, won't check off all of these, even if I went through 10. But if you can check off, say, 7, 8, 9 of the 10 elements, the better chance we have to uncover the next 10x stock. The first element that we look for is profitability, or real cash flow and earnings. Why do we require every small cap and every stock, for that matter, small or not, to be profitable from current operations before we invest in it? It's because the data is heavily on our side. And we'll look at a recent study on the data that looked at 10x stocks from 2012 to 2022 and how many stocks actually increased 10x over that time. Well, what are the core criteria? 87% of global equities or stocks that went up 1,000%, 10x or more over the past 10 years started small. 82% of those were profitable at the start of their ascent, and 91% had some history of profitability. So when you're looking at profitability, make sure you're looking at cash flow and real earnings, not analyst or management's favorably adjusted figures. So the next element that we would look at is a strong balance sheet. Best case scenario, the company has significant net cash position, which would be more cash than debt, and is able to fund operations and grow with cash on hand. With plenty of cash on hand, the company does not need to be asking bankers and shareholders for permission to expand. Plus, when times get tough, and they always can, a strong balance sheet provides a cushion exactly when those bankers and shareholders are most reluctant to provide more capital. Now, a strong balance sheet also gives the company power and flexibility in downtimes to not only weather the storm, but to play offense and make acquisitions when other great businesses are on sale. We saw this from one of our core focus buy recommendations, a company called Firan Technologies. During the pandemic, they were able to build up cash when essentially the aerospace industry was shut down. Some other businesses that didn't have that cash on hand, that net cash position, were in a tough situation. They were able to buy a couple of businesses, one primarily at a price they liked, and have been able to accelerate their growth coming out of the pandemic. And we've seen the share price go from around $2 to over $6.50. So finally, the company can continue with this strong balance sheet to make the necessary investments to stay ahead of the competition, which is something we always need to see. You can't just be good today. You got to be good tomorrow to be a good long-term stock. So you need to invest in being a better business tomorrow as well. Attractive valuations is the third thing we look at. Not necessarily the cheapest stock on the market, but are you able to buy that business or stock at a discount to what we would call the intrinsic value or fair value of the business? Whether using past or future earnings, book value, discounted cash flow analysis, or hopefully all of the above, does the business trade at a valuation that is significantly lower than its current and future value? And is there reasonable indication that the growth is sustainable? So number 4, we like a strong management team. Now, how do we measure the strength of a management team? There are a number of ways to look at it. Fundamentally, you can look at ROIC, or return on invested capital, or ROE, return on equity, give you an idea how well management allocates the capital under its control to profitable investments. Now, there are limits, and one has to look at of these ratios, and one has to look at each company on a case-by-case basis. Other ways we like to track management internally is whether or not they hit their targets with a degree of frequency. This increases our confidence in the future guidance and our forward estimates on the company. So if they tell us in one of their meetings, we're going to earn 10 cents per share in the upcoming quarter, and they hit or exceed that, they can get a check off in our book. If they miss it, the opposite is also true. Now, we want to stress that this is a management team, not just one individual, if possible, as key executives can leave the company. So that can be a risk. We like to see significant ownership with those key executives and the board in the business as well. A high level of ownership by top executives ensures that the interests of shareholders are aligned with the interest of management. Management is then less likely to do many of the stupid things that poor management teams do, such as chase top line revenues for the sake of growth, but not for increased profitability. That is bad for shareholders long term. We like them to be aligned. It aligns them to produce what we call, and what the market looks for, that's per share earnings and per share cash flow growth. This drives stock prices higher over the long term. Ideally, you might be looking for ownership between 5 and 40%, but it can vary based on the size of the company. If it's more than 50%, the principals can be in a position to reward themselves with lucrative compensation packages rather than serving the interest of shareholders, because basically they have the final say. And if it's less than 5%, there might not be enough alignment with shareholders. Again, that would depend on the size of the company. If you have 5% of a $10 billion company, you have a significant stake in that business at that point. Now, these metrics cannot always be achieved. At times, a founder who owns a significant stake in a business is not a great leader over the long term. So a better leader with less stake in the company can actually do a far better job. Aligning that person over time with shareholders would be a goal. Insider ownership should be investigated, as most of these metrics and criteria that we're looking at today, on a case-by-case basis. Now, those are 5 of the core criteria. There are many more that we use to help us identify good 10x stocks for the next potential the next potential 10x stocks to invest in. But that gives you an idea of 5 of the core criteria that we look at when we're looking to find a great investment.
Yeah, and today I'm actually going to be looking, like, on the Your Stock Our Take that I'm going into. I'm going to look at insider ownership and exactly how much the CEO owns, as well as just management and board. Just we can kind of go over a little bit of a case.
Yeah, and I know the company
this.
you're talking about, and
Exactly.
we interviewed management, and the management seemed very competent, but the insider ownership was very limited by the key executives there, and they had actually at one point sold.
Yeah, and I do
exercised
go over that
options and sold,
yeah.
and we're kind of happy with that. 20 cents to 70 cents, and that was an indication for us as and it was over a short period of time, relatively speaking. An indication for us is the business and the fundamentals look good, but is there? Why are you selling at that point, and why are you happy with that short-term gain? In a business, and this was a business that is contract driven and has had large fluctuations in terms of their revenues, not really a ton of growth over a 10-year period. And I just basically stole your segment. Right there.
Well, yeah, I mean, exactly. That's fine.
No,
but
but
like exactly that. Why?
He doesn't have to do a segment. He can just take.
You're done.
Ryan's always doing this, but no, it's good context. And that's the thing. Like, why would we want to be recommending the stock to our clients to buy the stock if you're exercising these options and then just selling them into the market? If you don't, have the thought, why would we be doing that? And again, it depends. Certain circumstances with a CEO and whatnot. I think in that specific circumstance, like he had said that they were selling shares to a big block to someone who wanted to enter a position. But still, again, like, as a CEO, don't you think you'd want more skin in the game if the outlook was rosy?
My question would be yes, or my thought would be yes, and that was raised kind of. It's not. It's a red flag that didn't fit off our criteria, and we didn't check that box off, and that company wasn't recommended at that price. And, the stock moved back from there, really. And that's been the high point for that company. But again, if there was a selling of shares and they owned 10%, they owned 1 million shares and they sold 25,000, like, who cares? Exactly. But if you own 100,000 shares and sell 90,000, that's a big deal, right? So, and there should be a reason that could be more justifiable than we saw there.